What's good, guys? In this video, we're going to cover SMT divergence. Now, the way that SMT divergence works, if you aren't familiar with divergence, then this might go a little over your head, but I think you're going to get the hang of it once you just look at the examples I'm going to show you guys. You want to use this with correlating pairs. So if you trade the indices, you want to look at S&P 500 as alongside of NASDAQ, alongside of the Dow Jones, or if you're trading currency pairs, you will look at GBPUSD versus EURUSD versus AUDUSD versus, again, USD-based pairs. If you're looking at yen pairs, you'll look at GJ versus EJ or UJ, etc., guys. I usually am trading the indices. This works very well on the indices. So S&P 500, NASDAQ, Dow Jones, right? And I also use it as well on EURUSD versus GBPUSD. I'll show you guys an example of that. The easiest way to look at this is by doing the double screen, the double chart layout on TradingView. If you don't have the paid version of TradingView, it's fine. You can just click back and forth between the two. It's a little bit more tedious, but it still works, right? It's nothing. It's not rocket science by any means, but this is how you can use this to help you find maybe more high probability trade setup, or just a trade setup that's less of a headache that yields you a better risk to reward. And what I mean by that is, so if you are looking at, let's just say you were looking at the S&P 500 and you said, okay, wow, I'm looking to get long on the S&P 500. You guys can see, looking conceptually from one chart to the next, if you were looking to get long during the 9 o'clock hour, so the 9 o'clock Eastern hour, again, we're coming into a macro during this time as well, which is it's crazy how often this plays out this way. But what you'll notice, guys, is really, really interesting. So if you guys look here on the S&P 500 versus the NASDAQ, is a couple things. So you'll notice that right here is the 9:45 Central Standard Time candle on the 5-minute time frame, and then you'll see that we have on this what is forming. You have lower low, but over here on NASDAQ, using the same pocket of time, you have higher low. You guys see that? It's a little bit trippy looking at it at first, but you have 9:45 right there, 9:05 to 9:45, 9:05 to 9:45. Okay, so you've got S&P giving you lower low, and then you have a NASDAQ giving you higher lows. So all this means is if you were looking to get long on the indices, guys, you would rather take the trade on NASDAQ or US 100 because it's stronger than the S&P 500. Therefore, the trade could give you a bigger move, but it should at least give you a much less, like a less headache of a move, I guess is the best way to put that. And the way that you could obviously pair more confluences with this, obviously you have, a run on liquidity right here on NASDAQ. You obviously have the run on liquidity here with S&P 500. Both trades will most likely play out still. It's just one will give you a bigger move or an easier move. And obviously, if you were looking to get an entry on NASDAQ instead of S&P after noticing this, this could have been your entry at the fair value gap. You could have looked for a break of structure on the 1-minute time frame. So you don't want to just only, again, use SMT divergence by itself. You want to have other confluences. And just by looking at the structure from this point forward, right, you guys can kind of see how NAS played out to the upside up until, the 1300 hour for me. Versus like S&P 500, it still got there. It still got above these highs just like NAS did. But in my opinion, just looking at this, like especially this move right here is so sharp to the downside. Like odds are if you were in this and break even, like let's say your entry came somewhere in here, maybe this ended up getting you out at break even and then it ran the rest of the way without you. But to me, this just looks like a much more difficult price action as it worked its way up there than NASDAQ, right? NAS kind of ripped right away. And very shallow retracements, like this sharp pullback on S&P. Look at the difference. Look at the difference. Like this did not even violate this low. This definitely violated this low. So it's just something to keep in mind. SMT divergence can kind of help you in that way. And then the other example I can show you guys is actually with the currency pairs. Okay, so if we go to, I think it was on the 15-minute that I saw this, for you guys. But if we go to the 15-minute time frame, EURUSD, GBPUSD, this is again from just this following week as I'm recording this video. So let's just say you were looking at taking a trade on GBPUSD, and I actually had this play out for me. I was looking at GBPUSD, and why I was getting in for that trade potentially was I saw this run on liquidity, right? I saw GBPUSD sweep this liquidity, and I'll mark this up for you guys so you can see what I'm talking about. I saw this run on liquidity, and I said, okay, great. I want to get in for a long on GBPUSD. But I looked over at EURUSD, and I noticed that, wow, we didn't even sweep the low that GBPUSD did. So now you have higher lows forming here versus lower lows forming here on GBPUSD. Now, again, did they both go to the upside? Yes, they did. They both went up. They're both going to still work out because the confluence is there. The higher time frame narrative is there. Like, it's still going to play out most of the time. However, looking at this, EURUSD, now you know that EURUSD is the stronger of the two. EURUSD is the stronger of the two, just comparing them side by side at the exact same time. Again, during the 9 o'clock hour, Central Standard Time, New York session, macro time. It's just, again, I'm telling you guys, it plays it over and over and over again. Tapped into this order block. So maybe after you realize this, you see this run on liquidity, price starts rejecting. You look over at EURUSD, you see, wow, it didn't even break down. It didn't even break past that low. That's what got me to take a trade on EURUSD instead of GBPUSD. And as you guys can see by the price action, very similar still all the way to the upside. So would either trade have worked out? Obviously, the answer is yes. But this is something that you will see play out on Forex. You'll see it play out on crypto. You'll see it play out on the indices for sure, over and over and over again. And I would say if you're somebody that trades a lot of indices and you're looking at NASDAQ, you're looking at SPX on the smaller time frames, it's going to be far more prevalent. And it's going to make that much more of a difference, I would say, especially when you're looking at the 1 minute, the 2, 3, 4, 5 minute charts. It's definitely going to make it a lot easier of a time for you trading these indices if you incorporate SMT divergence into it. The trade will still most likely play out, but you're going to get a better move or a cleaner move with factoring this in. Sometimes there might not be divergence. That's totally fine. But a lot of the times you will notice that if you're going between looking at the Dow, looking at NAS, looking at SPX, you'll see that there will be SMT divergence that forms very, very frequently. And if that helps you determine which one to get into, whether it's NAS or whether it's S&P 500, whatever it is, it's going to just make your trading that much more accurate, and it's going to just help you have a much healthier psychology with that trade instead of watching it chop around or maybe even work against you when it shouldn't be. It's just going to help you a lot. And this, again, is just something that can add confluence to your trade after you've already gone through everything else. You've already waited for the liquidity sweep. You know you're in a PD array, and you know that we should work to the upside or the downside based on what you're seeing with your analysis. So again, don't just use this by itself, right? Don't just see SMT divergence and just, ape right into a position, right? You want other confluence and underlying narrative telling you that you're going to go in the direction that you think it's going to go, but this can help you be more accurate with which one that you choose, and it only works, again, with correlating pairs, okay? So if you're trading USD pairs, you want to be looking at other USD pairs to do that. If you're trading the yen pairs, you want to look at other yen pairs. If you're trading the indices, just look at the other indices in the dollar index, maybe even just to see what they're doing, and then trade off of that. Okay, guys? So hopefully this helps. And at the end of all this, we're going to go over how we put all this together. Okay, so we've gone through every single concept now that I use personally, and then I'm going to show you guys entry models as to how I actually use these different concepts. Some I don't use them all together at one time necessarily. If I can, I will. But I'm going to show you guys a couple different entry models, both for Forex and for indices, and how I use this and put it all together to find high probability trade setups every single week in the market.